Foreign currency. Chapter 10 is about foreign currency. Suppose there is a company A. Company A is based in, say, USA. Whose currency is what? Dollar. They are trading with another country, company, that is say company B, and company B is say based in UAE. Whose currency is what? AED. Dirham. So company A have sold some goods to company B. Company A has sold some goods to company B. And suppose they have sold for $1 million on credit basis for 3 months. After 3 months, they will take payment from company B. How much? $1 million. But the exchange rate normally change. At the time of making a sale, exchange rate could be different. At the time of receiving payment, exchange rate could be different. And if there is difference between exchange rate, there will be either gain or loss. How that gain or loss should be recorded, we are going to learn in this chapter. How that gain or loss should be recorded, we are going to learn in this chapter. Foreign currency. So there is a accounting standard IAS 21 that we are going to learn. We have covered so many accounting standards. We have covered IAS 16, property, plant and equipment. We have covered IAS 20, borrowing cost. We have covered IAS 36, impairment of asset. We have covered IAS 40, investment property. What else we have covered? We have covered IAS 23, borrowing cost. What else?
38.
IAS 38, yes, IAS 38, intangibles we have covered.
IAS
What
41.
else?
IAS 41, agriculture.
IAS 41, agriculture asset. IAS 8, changes in accounting policy, estimate prior period errors.
IAS 2, inventory.
IAS 2, inventories. And we have covered IFRS 16, leases. And we have covered IAS 32. We have covered IFRS 9 and IFRS 7. All these three on financial instruments in previous chapter.
So revenue from contracts is which one?
Revenue from contract with the customer we will study in next chapter. The next chapter will be on revenue. IFRS 15, revenue from contract with the customer, IFRS 15. That was linked with IFRS 16 leases, but we haven't studied that standard. That we're gonna study next chapter. And now we are going to study IAS 21. That is relating to foreign exchange, foreign currency or foreign exchange. Do we need to remember these accounting standards? Yes. Because through the name of standard, we can recall their points, their knowledge with the number. Because to remember name of the standard is difficult. Through number, we can just make guess, oh, this standard was relating to this. Because there are some standards whose name are bigger, like revenue from contract with the customers. IAS 8. Accounting policy change, accounting estimate, and prior period errors. There is no chart. We should remember what we have covered. Is that? You are naming these standards. I just asked what standard we have covered. You are providing me the number and detail. So IAS 21 is about foreign currency or foreign exchange. So IAS 21, the objective of IAS 21 is to produce rules that an entity should follow in the translation of foreign currency activities. And if you are making any foreign buying, selling, how you will translate the currency, the amount, how you will calculate the amount while time of purchase or sale and at the time of receipt and payment if both dates are different. It is only individual transaction in foreign currency that are examinable in this paper, financial reporting. In next paper accounting, that is SBR, you will study how in group accounting foreign exchange works. In this chapter, we are going to discuss things about individual company, not about group company. So regarding group company, what are the foreign exchange rules? We will learn in SBI. Okay, what is a exchange rate? There are three types of exchange rate: historic rate, also called spot rate. Historic rate, also called spot rate, closing rate, and average rate. What is historic rate? The rate at the time of transaction. In when we are performing transaction, what is the market rate? What is the exchange rate? That is called historic rate. Mean rate at transaction date. So historic rate in place at the date of transaction take place, sometimes referred to as spot rate. Closing rate at the reporting date mean year end. What is the exchange rate at year end date? Suppose year end is 31st December. So what is the rate at 31st December? That would be called reporting rate, closing rate. And what is average rate? Average rate throughout the accounting period. And here we will discuss about historic rate and closing rate application. This average rate application will be in next level accounting SBR because this will be used in group accounting, not in single entity accounting. Assets and liabilities. Monetary and non-monetary. Monetary means that can be converted into cash easily, like receivables, payables, loans. These are monetary assets. Bonds, preference shares, but are non-monetary that cannot be converted into cash easily, like inventory, plant and machinery, intangibles. Monetary asset liabilities and non-monetary asset liabilities. Currency are of two types: functional currency and presentation currency. Functional currency means the currency in which we normally perform our transaction. And this is normally based on the country in which country you are performing business operation. You will use the currency of that country. If you are performing business operation in UAE, you will perform all the transaction in dirham. If you are operating in UK, you will perform all the transaction in pound sterling. If you are in USA, you will perform all the transaction according to US dollar. Not dollar, US dollar. Because there are some other countries whose currency is also dollar. Singapore is having different dollars. Australia is having different dollar. Canada is having different dollar. So what is a functional currency? the currency of the primary economic environment in which an entity operates. Mean the country where you are performing business operations. The environment in which you are performing business operations, the currency of that environment, that country is called functional currency. And this will usually be the currency in which the majority of an entity transaction take place. And what is presentation currency? The currency in which we prepare our financial statement. In most of the cases, both of the currencies are same, but they could be different. So the currency in which the financial statements are presented. Functional currency in which we perform transaction in the primary economic environment, and presentation in which we need to prepare financial statements. Either we need to prepare financial statements in dollar, though we perform transaction according to dirham, but we need to prepare financial statements according to dollar. So presentation currency and functional currency could be different. But most of the cases, they both are same. Okay. Individual company translating transactions, mechanism of translation. Initial transaction mean when we perform the transaction, we will record the transaction according to historic rate mean spot rate. Spot mean current rate. What is the current rate? So suppose current rate is $1 is equal to AED 3.65. This is called current rate or spot rate. Might be after 1 week, if we ask, they will say $1 is equal to AED 3.66. So that would be spot rate of that day. Translate using the historic rate prevailing the transaction date mean initially we record a transaction according to spot rate mean historic rate. The average rate can also be used if it does not fluctuate significantly during the accounting period. If there is not much fluctuation between average rate, then we can initially record at average rate. But if there are too much fluctuation in currency rate, then we should always choose historic rate. Settled transaction. Settled means when we made the purchase, that was transaction date, and when we are going to receive a payment in purchase, we are going to receive payment or paying. So that is a settlement date. If a transaction is a settled, payment or receipt occur during the accounting period, what does that mean? This is our year end. That suppose started on 1st January and ended on 31st of December. If we purchase something here and we made payment here. So this is where we purchase and here we make payment. Mean during the year. So if a transaction is settled during the accounting period, translate at the date of payment, receipt using the historic rate prevailing at that date. Mean we will record purchase according to the rate at this date. And we will make a payment, we record payment according to the rate at this date. As this may be different to the initial transaction, an exchange difference may arise. This is posted to statement of profit or loss account, treatment of exchange rate differences below. Means suppose while making purchasing, there was a rate of 3.65. While making payment, the rate gone up to 3.70. So 0.05, we are paying more. So that will be loss recorded where in profit and loss account. If at the time of making payment, the rate is 3.60, then there will be gain because we are paying less now. So that will also be recorded in profit and loss account. So for individual company, initial transaction should be recorded using a historic rate. Average rate can be used, but if there is no major fluctuation in the average rate. If there are too many fluctuations in the average rate, then we should always use historic rate. While at the settlement date, we need to use what? Historic rate. But if there is any gain or loss due to different exchange rate at a transaction date and settlement date, so that should be charged to profit and loss account for individual company. Okay, that's your understanding one. On 1st April 2008, Collins company, a company that uses the dollar as its functional currency. I mean, your home currency is dollar. Buys goods from an overseas supplier who uses Cromits KR as its functional currency. Mean we are buying goods from overseas supplier, other country, and their currency is KR. The goods are priced at 54,000 KR. But we need to record in dollar. Payments is made 2 months later on 31st May 2008. The prevailing exchange rate are. On 1st April, the exchange rate is KR 1.80 against $1. Can you calculate the amount of purchase in dollar? 30,000. How we have calculated?
Divided by 1.8.
Why not multiplied by divided?
Because we are converting.
There could be confusion in your exam whether we need to multiply with the currency or we need to divide with that rate. What you need to do, just make some calculation like here is dollar and here is KR. And in this quotation, if you see $1 is equal to 1.80 KR. And we need to convert 54,000 KR into dollar. So this means 54,000 KR is equal to dollar, mean dollar is X that we need to find. So through cross multiplication, we can find 1.80 X is equal to 54,000. So X is equal to 54,000 divided by 1.80. So X is equal to what? 30,000. Because sometime might be there is a case of multiplication. So perform this calculation. It will take 1 extra minute. It can save our question. Because in exam pressure might be sometime in a hurry student are calculating wrong amount. The currency conversion create. There could be multiply case as well. Like if $1.80 is equal to 1 KR. In that case, there will be a case of multiplication. So we will record the journal entries for these transactions. So first we need to record the purchase entry. So debit purchase with how much? $30,000 and credit payable with $30,000. When we settled at 31st May, the rate is 1.75. This means 54,000 divided by 1.75. Now we know this is the case of division. So what's the amount?
3.8.
3030
Yes.
30.857.
0.857.
This means we are paying more. But we will debit our payable with the amount that was in financial statement. We are paying a cash, so cash will be credited with 30857. This means we need to record on debit side some amount that is 857 to where? To profit and loss account. Whether that will be gain or loss? Loss. Can you understand this?
Yes.
In transaction date and settlement date for individual company. If there is any gain loss between transaction date and settlement date exchange rate, that should be charged to profit and loss account. Unsettled transactions. What does that mean? This was the year end. Started on 1st January and ended on 31st December. We performed our transaction purchase here, but the amount we make a payment here. Mean this transaction was not settled during the year. This means we need to record, suppose purchase liability here. And the rate could be different at the time of purchase and at year end date. So how this should be accounted for? If a transaction is still unsettled at the reporting date, mean year end, means still payable at year end is there. There will be an outstanding asset or liability on the statement of financial position. If the asset liability is a monetary item, that can be easily converted into cash, receivables, payables, loans, debenture, loan notes, bonds. It should be retranslated at the closing rate. Closing rate means the rate at this time, year end time. If the asset liability is a non-monetary item, property, plant and equipment, it should remain at the historic rate, mean it will remain the same, whatever the amount here, that will remain same here.
Inventory.
Inventory as well. Purchase is an inventory. Exchange difference will arise on the retranslation of the monetary item, or these are also posted to statement of profit or loss account. Mean for monetary item payables, we record here according to say this rate, the initial rate. But at the reporting date, if the rate is different, this means we need to record payable with this amount. And the difference we will charge to profit and loss account. Is it fine? Test your understanding too. On 1st January 20x6, Wilkie Company, a company that uses the dollar as its functional currency, buys goods from an overseas supplier who uses dinar as its functional currency. So there is a bank. The goods are priced at 35,000 dinar when on 1st January, and the 1st January rate is 1.75 to $1. Again, case of division as per previous question.
20,000.
20,000.
If your home currency is one, if your home currency is one, so home currency is 1. This is called indirect quote of exchange rate. And in that case, there is always a case of division. If foreign currency is 1, that is called a direct quote of exchange rate. Because this exchange rate, where we get this from exchange, they provide us quote. This currency is equal to this. So that is quote of currency. If your home currency is 1, that is indirect case. In that, we need to convert by division. And if foreign currency is 1, that is called a direct quote. In that case, we need to find the other currency by multiplying. Or you can perform like this. There are 2 currencies, which is 1 against what you are having, what you need to find, plus multiplication, you can find the other amount. Okay, so the transaction of purchase was made on 1st January with 35,000 dinar. So we will record debit purchases and credit payables with how much amount? 35,000 divided by 1.75?
20,000.
20,000.
20,000. Okay, what happens next? The goods are priced at 35,000. Payment is still outstanding at the reporting date of 31st March 20x6. The prevailing exchange rate are at 31st March, the exchange rate is 1.9. Can you calculate what is 35,000 as per 1.9?
18.
18 for
21.
18 for 21. This means now we need to record this payable to 18,421 instead of 20,000. In our payable ledger, there is 20,000 amount. So now we need to reduce payable by how much amount? 1,579.
9.
So what we will do, debit payable with 1,579. By debiting it in our records, it will automatically be 18,421 in the payable ledger. And credit we will charge to profit and loss account. And in profit and loss account, what is going on credit? Gain. That is 157.
Profit and loss account, even exchange rate gains.
Exchange rate gain. Foreign exchange gain.
And I had a question. For example, if there is a contract, then minimum you have to pay the. There is no such thing. No such.
So can you understand this? How we will record this?
Does this come under finance cost or like?
No, it's separate. We will record it gain, foreign exchange gain, foreign exchange loss, normal. Other, like other cost, other income.
Yeah.
Okay.
Is it fine?
Yes.
Treatment of exchange differences. If the exchange difference relate to trading transaction, it is disclosed within other operating income, operating expenses. Other income, other expenses. If it is relating to trading transaction, mean purchase, sale. Trading transaction mean inventory purchase, sale. If the exchange difference is relating to non-trading transaction, what are non-trading transaction? Purchase, sale of asset. it is disclosed within interest receivable and similar income finance cost. If it is relating to trading, mean purchase, sale of inventory, that is trading transactions. So that will be recorded at the operating expenses, other operating income. If it is relating to non-trading transaction mean purchase, sale of fixed asset, then it will be recorded as interest receivable or finance cost. The loss will be finance cost and the income gain will be interest receipt. As your understanding 3. Good luck, everybody. So ABC company has a year ending 31st December 20x1 and uses the dollar as its functional currency. On 25th of October 20x1, before year end, ABC company buys goods from Swedish supplier for Swedish krona to 86,000. And at 25th of October, the rate is 11.16. So this means debit purchases and credit payable with what amount? 286 divided by 11.16. Sorry,
25,812.
25,812, 25,812. Is that? Okay, the exchange rate at 25th October are this, 16 November are this, 31st December are this. Show the accounting treatment for the above transaction. If a payment of 286 is made on 16th November. So if they made payment on 16th of November, so they will debit the payables with the same amount 25812 and credit cash with how much? 286,000 divided by 10.87.
So it was 6.
26311. 26311. This means they paid more. They paid more. So they need to record debit of how much?
812.
Sorry,
Article 812.
812.
I didn't 25 equals to, I'm getting 25627.
You people are telling me amount. I am not calculating. I'm asking calculation from you guys.
2.627.
Was that 286,000 divided by 11.16?
25 points.
That is 25,627.
627, 25627. 25627. 25627. Okay, now what's the difference?
684.
So that will be charged to PNL 684.
684.
684. That is loss. Part A done. Now they are asking about the amount of remain outstanding at the year end date. So if it remain outstanding at the year end date, so we need to calculate 286,000 divided by 11.02. What's the amount?
25,952.
25,953. So the original was 25,627. This means the liability should be increased by how much? By how much the liability should be increased? By how much the liability should be increased? 326.
Yeah.
So to increase liability, we will credit payable. And in debit, we need to record what? Profit and loss account 326. That is what? Loss at year end. Is that fine? Yes, we need to increase or decrease liability at the year end. We don't need to do anything with purchase. Though the amount of purchase was this at year end due to exchange rate, but this is inventory. That is non-monetary item, not monetary. Only monetary item we need to retranslate at reporting date. Using the closing rate. Closing rate means rate at year end. But is also spot rate. But at year end rate is called closing rate. During the year rate is called historic rate. So chapter finish.
Really?
Non-monetary item for fixed assets, etc. If we are recording on cost model, non-monetary items that are held at cost are initially translated at the historic rate and carried forward at this value. Even if the year end rate is different, their value will remain same at the year end. They are not retranslated. Only monetary item we need to retranslate at reporting date using the closing rate. But for non-monetary item, if we purchase during the year, we have calculated according to that transaction date rate, they will remain the same at the year end date. Even if the exchange rate is different at the year end, their amount will remain same. If we are recording on revaluation basis, non-monetary items that are carried under the revaluation or fair value model are initially translated at the historic rate. And when revalued, the fair value will incorporate the exchange rate on the date of revaluation. On the time of revaluation, we need to retranslate using the current historic rate. And if there is any gain or loss that are not separately recognized, they should be charged to P&L. For monetary asset, we need to retranslate at the reporting rate using closing rate. For non-monetary item, don't need to do anything, they will remain same. Test your understanding 4. Data for question 1, 2, 3. An entity based in US sold goods overseas for krona 200,000 on 28th of March 20x3 when the exchange rate was $0.652 $1. $0.652 $1. The customer paid in April 20x3 when the rate was $0.702 $1. The exchange rate at the year end 30th June was this. I mean, they have given three rates: transaction date, settlement date rate, and reporting date rate. Number one, prepare the journal entry to record the sale of goods by the US entity. What's the accounting entry for credit sale? With how much amount? 200,000 divided by 0.65.
No.
200,000 divided by 0.65.
It's based in US only in dollar.
0.65. Dollar. KR $1 is equal to 0.65. We are having 200,000 KR and we need to find X. So 0.65 X is equal to 200,000. So X is equal to 200,000 divided by 0.65. What's the value?
30769.
307.
692.
307,692. Part question 1 done. Number 2, show the journal entries to record the payment in April 20x3. The rate is 0.70.
Yes.
How much you are receiving? Receiving or paying? Receiving. So cash will be debit. Credit will be receivable. Receivable will be credit with the same amount 307,692 to eliminate it. But how much cash you are receiving?
857.4.
285,714. So there is a difference of how much?
1977.
21,977. That will be loss. That will be charged to profit and loss account. Is that?
Yes.
So number 2 also done. Number 3, if the amount was outstanding at the year end, what would the gain or loss in the statement of profit or loss will be? So at year end, the rate is different. This means we need to change the receivable. Can you calculate the amount against 200,000 KR with 0.75?
66666.
266,666.
67.
What is your receivable? 307. This means you need to reduce the receivable by how much amount? 31?
25.
025.
025. Where that will be charged? The sale will remain same. Can you understand this question 1, 2, 3? Easy. Number 4. An entity based in US purchased goods for 200,000 on 28th of March when the exchange rate was 0.65, meaning the same value But the accounting entry is relating to purchase. So debit, we will record purchase with how much? 307692, and credit we will record payable 307692. The exchange rate at the year end 30th June was this. If the goods were unsold at the year end, what should be the value of inventory? What will be the value of inventory at year end? It will remain same because inventory is non-monetary item. Only monetary item we need to retranslate at reporting date. Non-monetary item will remain same. Is that? Number 5. An entity bought land on credit for 100,000 KR when the exchange rate was 1 KR by $0.85. Now this is a case of multiplication, and if we multiply, that will be 85,000. At the year end, the entity had not paid its supplier. The exchange rate at the year end was 92. This means at year end, the land value will remain same, but the supplier 85,000 before, now it will become 92,000. So there is an increase in payable. Supplier mean payable, that is 7,000. Increase mean payable credit with 7,000, loss debit. Which 3 of the following amounts would be recorded in statement of profit or loss account in financial statements? Property, plant and equipment with 85,000. Land. Trade payable with 85,000. No, with 92,000. Foreign exchange loss with 7,000.
Yes.
Property, plant and equipment with 92. Trade payable with 92. Chapter finish. Let's discuss some MCQs. I couldn't find the particular MCQs relating to this chapter from BPP Kit, so we are covering MCQs from that one. Good luck everybody with the 98. What is a functional currency? Primary economic environment in which an entity operates.
Option D.
99. Good luck everybody. What is the carrying amount of the land at 31st December 20 X1? Carrying amount of the land at 31st December 20 X1. Sunshine is an entity with the reporting date 31st December 20x1 and a functional currency of dollar. On 30th June 20x1, it purchased land from overseas at a cost of 30 million dinar. The land is an item of property, plant and equipment and is measured using the cost model. Exchange rate at 30th June is a 3. So 30 million divided by 3, that will be 10 million. And at 31st December, it will remain the same because there is no information about depreciation. Otherwise, we need to deduct depreciation to find the carrying amount. This should not be retranslated at reporting date because it's a non-monetary asset. 100. In relation to IAS 21, the effect of changes in foreign exchange rate, which of the following statements are true? Exchange gain and loss arising on the retranslation of monetary item are recognized in other comprehensive income. This means one is wrong. This means option C, D, and A are wrong. So non-monetary item measured at historic cost in a foreign currency are not translated at the reporting rate. Yes. An intangible asset is a non-monetary item. Yes. 101. Good luck, everybody. What is the total loss arising to nearest thousand on the above transaction in the year ended 31st December 20x1? Total loss. Total loss. So an entity took out a bank loan for 12 million dinar on 1st January 20x1. 12 million dinar. We need to calculate into dollar. And on 1st January 20x1, the rate was 6 dinar per dollar. Is that? And 12 million dinar divided by 6 is equal to what? $2 million. Is that?
Yes.
Okay. It repaid 3 million dinar to the bank on 30th November 20x1. 3 million. They paid on 30th November. How many dollar?
6
0.6 million.
Yes, possibly.
Is that? We can say this is what 2000 and this is what 600 they have paid. The entity has a reporting date of 31st December 20x1 and a functional currency of dollar. Exchange rate are given below. This means out of 12 million, you have paid 3 million. How much is remaining? 9 million. What is that?
160,7142.
What?
160,7142.
16017. We can say we are having a 160. Is that 1607?
142.
142. Mean in simple word, in nearest 1000, it's 1607.
07.
So this you are having. This much you lost. How much is that?
The value known at the end.
It's monetary asset. It's monetary item. Monetary liability.
The double amount.
So what's the difference?
993.
How much? Is 1607 is the remaining balance. 2000 minus 600, 1400. So that will be 207. $207,000. Or you can calculate both different losses like for 3 million, the amount calculate at this. And then for 3 million, the calculate this, you can calculate that loss separate. And for the 9 million, calculate amount at this and then calculate amount at this, that loss separate. And by adding both the losses, you will calculate 207. Is that?
Yes, sir.
Ah, you can calculate like this. Because at year end, we need to record a liability using this amount.
Yes. Yes.
Using this. What we were having at the start, what we have paid, and at the end we are having this. So the difference is covering losses for both these 3 million as well as the remaining 9 million that was changed. 102. What is the carrying amount of the machine at 31st December?
Yeah, for instance. Questions. 19.
So manufacturing entity buy a machine and item of property, plant and equipment for 20 million dinar on 1st January, and at that date, 2 dinar is equal to 1. So 20 million divided by 2 is equal to what? $10 million. Okay. The machine is held under the cost model and has a useful life of 20 years. The entity has a reporting date of 31st December and a functional currency dollar or exchange rate are this. And at 31st December, the rate is 3.0. Average rate is 2.5. But this is non-monetary item. We do not retranslate using the closing rate. So it will remain same. And depreciation for 20 years will be 0.5 million. So 10 million, 0.5 million by deducting, we can calculate carrying a value 9.5 million. So this is the cost and this is depreciation.
Side, it's just
The other side, what the other side?
for 20 divided by 20, like that.
Why you are dividing 20 by 20?
The depreciation to calculate.
We are calculating everything in dollar.
Mm.
So try to calculate everything in dollar. Is that fine?
Yes.
That's it for the day. See you tomorrow with something new.
Tomorrow at the
And then
same
we'll
time.
be having class on Friday as well.
Inshallah.
That's it.
Okay, sir. Thank you.